everyone. Welcome to the next video in the video series. In this video, we're going to talk about how to set a stop loss. Now, I know stop losses can be a little difficult, but I'm going to attempt to help you understand how to do it, and hopefully from here in we can move forward with it. We're just going to start with oil. A little while back, it looks like maybe, what was this, June 24th, we were eyeing this wedge formation here. And this is exactly what we look for. This is the type of thing we want to trade. So we're going to figure out how we would trade this. So in order to trade this, which I'm sure everybody knows, we need to set up. Now remember, when you make your lines, like this line here was made from this tool right here, the line tool. So that's the true line there. But when we trade, we're going to go from here to here. So the line should be more like at 61.5, but don't worry about that right now because that's not too big of a deal for the moment. So let's just say our buy price would be 62, one box above the line, and our sell price would be, let's say, 59, one box below the line, or maybe 59.2. So now if the price goes up, our buy order will come into play, and then as the price continues up, we'll be making money. If it doesn't go up, instead it goes down, our sell order will be executed, and then we'll be making money on the down. But how do you set the stop loss? So the stop loss on this particular chart is good because the formation is tight. So that leaves the peaks to be close and nearby, and we can have a relatively short stop losses. Some charts, if we didn't see this area right here and we were trading from this part right here, then our stop losses would have to be like big distances, and that's not that good. So we would rather find tight formations like this, ones that are ready to happen. If it was over here, it's not quite ready. It could happen, but it's most likely going to pinch longer, and it did for a half a month. This is a 4-hour chart. So our stop loss on the up, really there's two, maybe three places you can actually place this. The first place is pretty much approximately a box below the break line. So one box below the break line, which would be about right at 60.52 right here, you could put your stop loss there. And why you would put it there is because, in theory, if the price comes back down into the break line and passes the break line, then it will reverse and go down and break the other line. So that's the theory. So that's why you might put your stop loss there. The next place to put your stop loss is at the last resistance point, which seems to be about right here. Or, you could do there, but I would do there for sure. So let's just say that's number 2. So we'll say 59. And the reason in theory for that is that if it comes down and breaks, it's most likely just retesting the line like it commonly does. And then if it doesn't go below the last resistance, then it continues up. And that does happen often as well. So you can put your stop loss there. And the third place you can put your stop loss is right here, the furthest distance, 57. So you got one stop loss here, another stop loss here, and another stop loss here. And this one, the theory of this is that this all breaks, everything's good, but because it doesn't pass the bottom resistance line, the main resistance line, then, or support line, sorry, the main support line, then it will continue to go back up. But I don't see why you would ever want to put your stop loss there. I really don't. There might be some reason, unless you're working on the truly long term, because that's a fair distance. Each box is 50 pips, so that's 51, 52, 53, 50, 450, 450 pips away. I don't like that. Anyways, so In this particular trade on the up, I would put my stop loss probably like it could go here, 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 or there, but I'm going to go right here. So let's just say 59. Take profit. We'll talk about take profits in another video. Let's just work on the stop loss. So now let's say the price goes down and my sell order gets executed. Then I want to place my stop loss for that in a similar fashion as I would have the other way around. So the price breaks. There's really three options here. I could do one box above the break line right in there. So at like maybe where the price is right now would be my stop loss. Then there's the last resistance point, like right here, the very top. And you could do it here. It just depends which one you feel more comfortable with, or you can do it at 62. So all these peaks are potential stop losses. Same as these, potential stop losses, whichever one you feel most comfortable with. And we can look at a few charts that have made formation moves, and we can see how the breaks happen, and we can judge what we would like it to be when we trade. However, you have to understand that every trade is different. Not everyone has a nice small amount of peaks in there. One might just be like this, and like there's so many different variations that it takes work every time. So if the price goes up and hits 62, we get in on the up. Our stop loss is right here. If the price goes down at 59, sorry, one box below, yeah, 59.5, then we get in at 59.5, and our stop loss for this one, I would feel comfortable with right here, the last previous peak, so 61.5. So we went 100 pips there. And pulling up the current chart, because this happened on the 24th of June. Now we're on the 17th of July, nearly a month later. Let's see what happened. Okay. So as you can see, same chart. That's what happened. Boy, I love this strategy. Okay, so what happened here? The price had broken below the break point of the support line. Now, it never really, like it did a little bit, it went up a little bit, but I don't think we would have been in here. We were supposed to be in at 59.5. So 59.5, we were never in danger of any stop loss ever being hit. It just continued from there on in down. So our stop loss was never tested, and we have made in less than a month, let's see, 51, 52, 53, 50. Almost 950 pips in a month's time. So that's actually quite good. Now, what will we do from here? Well, what we would do from here is we would move our stop loss from up here and move it down here. So now, if the price goes backs up and hit that, then we will be out. Some people may not feel comfortable with that, like that's a long distance. Maybe you want to just half that, but like to this point here, that would be acceptable. Another thing you can do here is you can decide whether or not you wanted to place another order. So what it looks like to me, something like this. So it looks like it's going to continue to go down, but it may not. It may right at this point decide to come back up here and test this line again. So if you were going to make your next trade, you would have done it somewhere around here or most likely here. Okay. Now, the thing about this chart is if we go on the weekly, we can make one of our longest term trend lines, like right there, and you can see that that's most likely where it's going to go. So that's about how much more space you have to trade. Okay, moving on, because we're not talking about take profits, we're talking about stop losses. So that was a nice trade. Feel good about that. Gold on the daily. A previous move had a wedge formation similar to that oil that we just saw. We would have done the same thing. We would have put one box above and one box below. Our stop loss here. Okay. We can either do, we're not going to talk about the bottom, just what happened. So it broke up here. Our buy order went in. Our stop loss could have been in this spot here, about one box below the line, or it could have been at the next peak, or the next peak, or the next one. Usually not this one or these. It's usually the first one or the major one. So most likely here, here, or here. And for me, I would always feel most comfortable in this trade putting my stop loss right here at 1590, which would be oh, this is daily. That's actually quite big. Quite big. I guess you would have to have a fair amount of money to trade this, but that would be 4,000 pips. Much too much. Well, you have to have a lot of money to trade gold in the long term, and that's no lie. So a 4,000 pip move, but think about the amount of pips that you could have gained here. Amazing. So as you can see, the price busted right through. It never once thought about coming back and touching the line. So we were safe no matter where we put our stop loss again. This one, same thing, one box above the line. There was one here, there was a wedge here. I just didn't make the line. We could have did one box below that line. Price never moved down and never touched our stop loss because I would have put our stop loss right here at the first peak from the break. That's the first peak, that's the second peak, that's the third peak. That's your options for this trade. A stop loss here, a stop loss there, or a stop loss there. Notice how I didn't do one box below the line? I didn't do one box below the line because this peak here is pretty much one box below the line. So it's a good spot. This is a perfect trade because you can't get much closer than that. This is a 2-hour chart. That is, what is that? That is, looks like a 20 pip difference. Imagine that, 20 pips. That means with $1,000, 20 bucks a pip. And if you had from 1717 to 1747, that would be $300 pips. So 300 pips in a week. That's pretty good. Pretty good. 300 pips times 20 bucks a pip. What is that? 6,000? Yes, 6,000. Not bad for a week. As you can see, our stop loss was never tested again. Now, The New Zealand US dollar. Now, here's one that shows multiple different cases where you could put stop losses, and one of them actually would have stopped you out, which is fine. That happens. I mean, if it happens, it happens, right? I mean, we just made $6,000. What's a loss of 800 to $1,000? Nothing. So we have our line here. You have your one bounce, your two bounces, and your confirmed bounce right here. Then on the fourth bounce, it made a sort of a false break. It broke through the line, but then came back up past the line. Now, had we have put our stop loss at 1 bar above the line, we would have been stopped out. But had we have put our stop loss at the last previous peak, we would have been safe. Or stop loss 3 or stop loss 4. Why you would put your stop loss up here is beyond me. If the price is going up there, there's no reason to do that. I mean, it would have to be quite the long term. And even then, there's like a line right here. So if it's going up there, it might break through that and even go higher. Like, it make no sense. So really, I don't know why I would even put stop loss for it, because we would never do that. Even this one is unlikely. It's most likely just this one or that one. And that one is the one I probably would have picked, yes, this one, the last previous peak for sure. And that was 20, 40, 60, 80, 100, 120 pips away. That's normal. That's an average amount. Not bad. Now we have the Euro New Zealand dollar, and we have a previous movement here. So we had a wedge formation happening. Not the best looking wedge formation, but one nonetheless. When it made its break, we would have had our buy order one box above the line, maybe right here. And our stop loss could have been one box below, pretty much this peak or this peak. That's it. And I probably would have chose this peak just to be safe. So again, stop loss never even came close to coming back that way, and forever since it's been going up by quite a bit. So that was an impressive move. The Great Britain pound, Canadian dollar. Now, if my memory serves right, oh, never mind. I'll deal with that later. So anyways, you have your line here. You have your break point right here. You could put your stop loss one box below the line. Now remember, your stop loss needs to trail that line. So if time passes, and it has, and this price was like right here, then your stop loss should be a little lower than what it used to be. Otherwise, it would be here, and it's not one box below the line. So you want to bring it down. So this is a weekly chart, so every week you would bring it down. Once the break happened, you can see commonly this does happen. The price shoots up, comes back down, tests the line, and then soars away. So what we have here is a bit of a test on the box below the line, but really we were in no danger of being knocked out of this trade either. So again, the first stop loss, one box below the line, would have been sufficient for this, but I would have chose the last previous peak, which was about a box and a half below. So looking at the Canadian Japanese, this is a move that has not happened. This move here, we would place our trade. You can see there's a sort of a wedge formation starting to happen here. If we get another bounce, we might see a nice little pinch. But until then, and we're ready to make our trade now, how we would have to trade this is when the price goes below the line, one box below the line, we get in on the down, we sell. Our stop loss, we have two options. We can one box above the break line, or this peak right here. We can make it this peak right here, and that's not really a peak, but that's just some kind of level, so I chose it. Or this one right here, and they are let's see, 110, 100,000. This is the daily chart. Okay, so that's pretty far. So 1,000, that's 2,000, 3,000 pips away from the break. So really, you might just do one box above the line here. Again, this is a long-term trade, the daily. So these movements, this is a lot of movement in there. Um, that's why you have to have so many pips of a stop loss, which looks like nothing, but because it's a daily, it is a lot. If this was the hourly chart, then a movement like this would be more like 100 pips. So we'll keep that in mind. If this breaks, it most likely will not come back up to test the line. I'm pretty confident, but you never know. So moving on, gold. You have your line here and your line here. Now, because this is a long term, and you can see each box is like months, is a month or so. We're not going to put a trade on the up because we're nowhere close to that, and we're just going to waste our time. So we trade in on the down. Looking at this chart here, I can see that this wedge is broken. So if this wedge is broken, the reason why I have these below the line is because I had it on the line chart, and this is where the points end. So this is clearly a break, and the reason is because the price, this last candlestick here, closed below the bar. These didn't close below the bar. They went below the bar and then went back up and then closed. This one went below, went back up, and then closed. This went below and closed below. And then the next one went open and it's still below. If this one closes, it's even a double confirm. But right now, I'm pretty confident that this is a break. So to trade this is a daily on the gold. You need lots of money most likely. So we're going to do minute type trade here. We're just going to hope that it soars down. So we will buy in on the down pretty much because we've gone one box below the line. So we can buy a live market trade on this trade. We don't normally do that, but because we're right at the moment where the break is happening, our order would have been executed here. So we're going to be our order, and we're going to execute our order right away. And we would go in on the down here. Our stop loss for here, I would have to say, would be one box above the line because we're not going to be able to afford that. That's let's see here, 110, 100,000. So that's 4,000 pips. Let's be realistic. Let's put our stop loss just a box above the line, which is that's even too much. We would have to, that's 2,000 pips. So that's what it would have to be if you're going to make this trade, a 2,000 pip stop loss, which is still doable. That makes it, if you put a $2,000 trade in this, it'll be $1 a pip, which is not that good, but that's all right. So our options for stop loss, one here, one here, one here, and we chose this one because it's what we would be able to afford. This would be unobtainable unless we have a lot of money, and same for this. So, and imagine we put it up here and then it went up and passed and then we lost all that money. Oh, that would suck. Let's see. This was yesterday. Let's take a look and see if that continued to move. Yeah, it did. So we were on, what chart was that? The daily. So yeah, look at that. It continues to fall down compared to what it was doing. There it is now. And we have moved, let's see. No. Yes, this is a daily chart. Wow, it's moved a lot. So each box here is 50 pips. So you got 51, 52, 53, 54, 55. Almost 550 pips in a day. Wow. That's why I like gold. Movements in gold, like just little movements, are big movements. Like if you go in on the hour, that move there is a huge move just on the hour. On other charts, it's not as big, but each box here is 200 pips. So like you can see 0.01 is 1 pip. So 0.10 is 10 pips and 1.0 is 100 pips. So 200 pips per box. It's crazy. Amazing money. Imagine. So I think that's about it when it comes to stop losses. So most of the time when you have a stop loss, you have three options. One box on the other side of the break line, the last previous peak, or the second last previous peak, or the major previous peak. So, four different options sometimes. Every time is different. I hope this video helps you decide how to make your stop losses, and if you have any questions, you can ask me. So thank you for watching the video, and I'll see you next time. Bye.